What on earth is net unrealized appreciation? Hi, I'm Doug Ray, founder and president of the Wealth Guardians radio show and the Ray Financial Group.
And I'm Brice Payne, and you've entered The Vault, the Wealth Guardians video series on all things pertaining to retirement planning. In this episode, we're going to cover and explain what NUA, net unrealized appreciation, is, and we're going to run through two case studies, one where somebody takes advantage of NUA and one where somebody doesn't, and show you what the difference is. Don't forget to hit those like and subscribe buttons down underneath the screen there if you're so inclined to catch future episodes of us. And let's go ahead and get to it, Doug. First off, explain in simple terms what NUA, net unrealized appreciation, is.
So this show is for those of our audience that have stock, company stock, in their 401k plan.
Which most people don't.
Well, no, but if you work for Lowe's Hardware, you could.
Yep.
Reynolds, you could.
Yep.
So several companies out there do offer that. So net unrealized appreciation is your ability to take advantage of the tax code. So instead of taking money directly out of your 401k where it's fully taxable at your current income tax rate, you would take a distribution of your highly appreciated company stock in kind, and you'll only pay tax at your tax rate on the cost basis.
Okay.
Then if you hold that stock for at least a year or longer and then sell it, then the gain, you'll pay long-term capital gains tax rates on that, which could be substantially less than your income tax rate.
Okay. Well, let's run through two case studies here then. So we've got a person who has $10,000 of cost basis on their company stock in their 401k.
Okay.
Let's say that it's grown to $30,000,
okay,
but the cost basis itself is $10,000. We want to assume that this person is in the 22% tax bracket for these case studies. In situation A, the person rolls their stock over into an IRA, and they eventually sell it, and they take a distribution.
Okay.
The result on that would be a 22% tax at the time that they take a distribution on all $30,000.
That's right, $6,600.
$6,600. Okay, so that's case study number one, $6,600 in tax. But for somebody who utilizes the NUA rule, this person takes an in-kind distribution of company stock from their 401k, and they hold on to it as company stock.
Right.
Maybe they deposit it into their brokerage account. They hold on to it as company stock for at least 1 year.
Right.
Now, at the time that they took the in-kind distribution, they had to pay 22% tax
on the $10,000 cost basis.
Okay.
And your 401k provider will report that on a 1099-R in Block 6.
Okay. So that was a $2,200 tax at that. Well, they would pay it at the next tax filing season, but that was the tax result of that. And then B, later on, a year later, we fast forward a year, they're still holding onto the stock, but now they decide to sell it. And it's grown to that $30,000, or it's valued now at $30,000. They're at this point going to pay what?
So you've already paid tax on your cost basis of $10,000.
Okay.
Now you're going to pay a long-term capital gains tax on the $20,000 gain.
Okay.
And let's assume you're in a 10% long-term capital gain tax rate.
Right.
So that's 10% tax on $20,000 gain, or $2,000.
$2,000. Okay.
So all total, you've paid $4,200 in tax for a $30,000 distribution.
Very good. So that $4,200 tax is 14% of the $30,000. But in the first case study, they paid $6,600.
Right.
So that's a difference of $2,400, or a 36% savings by utilizing the NUA.
Exactly. And you can see, if you've got even more stock than this $30,000 example, how important taking advantage of net unrealized appreciation can be for you.
Now, Doug, you've been in this field for 30 some years. How many times have you seen somebody who wasn't aware of this or had an advisor who wasn't aware of this, and they got caught behind the 8 ball and paid more tax than they had to because they simply weren't up to date on the NUA rule.
Yeah, there's a current client of ours that this happened to several years ago, and his advisor at the time had him sell the stock in the 401k. It was very highly appreciated, and he missed out on a great opportunity to save probably 40% in taxes.
I would say a vast number of people who have the NUA opportunity for them to save taxes are completely unaware of it.
Yeah, I mean, it's not something that's discussed every single day. And most 401k providers, well, they don't tell their 401k customers about this law.
That's right. Well, there it is in a nutshell, what NUA is and how it can have an impact on your tax bracket or what taxes you pay Uncle Sam. Doug, anything else we want to add on this one?
I think that's got it covered.
All right, that's going to wrap it up for this episode of The Vault. Again, feel free to hit the like and subscribe buttons down underneath the screen there if you want to catch future episodes of ours. I'm Brice Payne.
And I'm Doug Ray.
And this has been The Vault.